This video presentation is about poverty line according to World Bank and Islam, and this research was first published on October 17, 2014. This research was conducted by onlineislamicfinance.com and islamicfinanceonline.wordpress.com. The main purpose behind this research was to throw some light on the paradox of poverty line or poverty threshold, which has been defined as the minimum level of income deemed adequate in a particular country for survival. Now, up to 2007, the international poverty line has roughly been around $1 a day, but in 2008, the World Bank came out with a revised figure of $1.25, which was the purchasing power parity at that point of time. With that data in hand, let us do a simple straight line calculation. The figure that we have is $1.25 a day. Now $1.25, applying the exchange rate of 61 rupees and 48 paisa, which was the exchange rate on 17th October 2014, we get 76 rupees and 85 paisa for 1 day. So similarly, for 1 month we have approximately rupees 2,300, and annually we get the figure of around rupees 27,666. Therefore, anyone earning equal or less than the above is poor according to the modern world. To understand the same in Islam, we'll have to look at the zakat system. Zakat is the Islamic tax of 2.5% on wealth and savings above Nisab value, which is primarily for redistribution and benefits to the downtrodden. In Islamic Sharia, Nisab is the amount a Muslim's net worth must exceed for them to be obligated to give zakat. Several hadith have formulas for calculating Nisab, the most prominent of which declares that no zakat is due on wealth until 1 year passes. Zakat is determined based on the amount of wealth acquired. The greater one's assets, the greater the tax. Unlike income tax in secular states, Nisab is not subject to special exemptions. So as we have clearly established that in Islam the concept of zakat revolves around Nisab. A Muslim's worth must exceed the Nisab value to be required to pay zakat. If less than Nisab value, a Muslim is exempted from paying zakat. In other words, the person is identified as poor or below poverty line and therefore exempted the Islamic tax. So to find out the poverty line according to Islam, we have to calculate the Nisab value. There are primarily two ways of doing it. One is the Gold Dinar standard and the other is Silver Dirham. It is a straight line calculation and therefore we will be using the gold standard. So for 1 year, we have the figure of 20 dinars of gold at the rate of 4.25 grams. So this gives us 85 grams of gold. And the value of gold as on 17th of October 2014 was rupees 27,400, or approximately $445 for 10 grams. So for 1 year, the figure is 2,32,900. Similarly, for 1 month, we get 19,408, and henceforth we have the figure for a day. Therefore, anyone earning less than the above is poor according to Islam, and hence that determines the poverty line or threshold at approximately $10 a day as compared to $1.25 a day by World Bank. Hence, anyone earning less than rupees 19,408 or $315 approximately a month is poor or below poverty line and needs special assistance packages, benefits, programs, help and aid by the governments and international organizations. Islamic Sharia or Islamic law is approximately 9 times more just, financially inclusive, economically considerate, practical and relevant to modern times when compared to Western world institutions like International Monetary Fund, United Nations and World Bank. Islam identifies poor and poverty 9 times better. These facts clearly corroborate that Islam successfully identifies the economic status and poverty level because it has been linked to gold and silver standard. If you do some research about money in Islam, you will find that the free market principle is in fact an Islamic principle. Islam considers commodities with intrinsic value as currency. The following are some examples of commodities that can be used as currency in Islam. We have the Gold Dinar, the Silver Dirham, we have rice, dates, wheat, barley and salt. Paper money or electronic money can be used as long as it is backed by one of these commodities at a fixed exchange rate, which means that the paper is just a contract stipulating that the bearer can redeem the paper for a fixed measure of that particular commodity. Until 1971, most currencies of the world were backed by gold. But you need to find out what happened after 1971. However, only governments could redeem paper, not the average citizen. The price of a commodity is set by the market as long as fiat currency or paper currency is not used. On the other hand, the price and value of commodities can be manipulated, adjusted by the creators of fiat money on the principles of demand and supply. So you need to pay special attention to the last part of this article, the last paragraph. To elaborate what we've just looked at, we need to also look at some of the selected points from the rich Islamic economic system that would also help us check inflation. The first point is hard currency, which is tied to the gold standard. Today, countries artificially create currency by printing money as required. Whenever our government borrows money, it is effectively printing the money and devaluing our currency and the very notes that we have in our pockets overnight. This, in fact, has a big knock-on effect on inflation. It is in fact scary when you think about it, because the very notes in our pockets have no intrinsic value of their own and only possess the value of the paper they are printed on. The Islamic system, on the contrary, requires currency or medium of exchange to be based on the gold and silver standard, which definitely have an intrinsic value. Notes can be used to represent the precious metals instead of carrying gold and silver around, but they must be backed up by them. Due to the intrinsic value in the precious metals, stability is achieved and devaluation and inflation checked. The second point in the Islamic financial system is that there is no scope for having any artificial money. Even printed money is artificially created via bank loans. Banks regularly loan out more money than they have, and there is in circulation. That is, they lend what they actually don't have. For example, in the United States in 2007, the debt was 7 times the amount of money in actual circulation. I'm talking about the property bubble. This artificial consumer spending power also leads to inflation, as artificially increased money supply is competing in chasing limited goods. The Islamic system doesn't only forbid riba, which is interest, but also does not allow you to loan what you don't own or what you don't have. Money cannot be pulled out of a rabbit's hat. It cannot be created out of thin air. Banks cannot produce money.